Good morning once again, and welcome to the Haven Financial Group radio show. I'm Larry Colvig, founder and CEO of the Haven Financial Group. This segment, we got Glenn Ramey, our insurance specialist, one of them at the Haven Financial Group, talking about college costs, expenses, what you can do to prepare. But if you're not at that age, or maybe you're just worried about your own retirement, although this show today is on college and how to plan, and you're worried about your own retirement, that might be another reason to come on in, visit with us on any of the retirement topics that we really specialize, which is all the retirement puzzle pieces, to make sure your puzzle looks like it's all going to be put together in the way it's supposed to. So we encourage you to give us a call, 612-504-8400, or visit us online. Kim, it's great to have Glenn with us again, talking about how life insurance can be very valuable in preparing for those college costs.
Well, this is so interesting to me, Glenn and Larry, and it's great to have you, Glenn, because, life insurance for the longest time was just about people passing away and leaving, money, and that's that. But it has sort of taken on this new idea of life insurance, during the course of our life as we live. And boy, I can't imagine a better way than possibly helping our grandkids or our kids go to college. 529s are great. There are some restrictions, but Glenn, my understanding is that there are fewer when it comes to universal life insurance.
Yeah. So I actually have a personal experience just this year in helping a couple with something exactly like that. Two young children with a couple that were both well-earning engineers, and they were looking for ways to fund college for their kids in a way that wouldn't have strings attached, could, if structured correctly, be tax-free distributions to help their kids with their college expenses. And considering colleges are increased 40 times since 1963, even in just with inflation, that's a 200% increase in what people are paying to go to college nowadays. And the fact that college degrees are much more of a requirement and entry, even in occupations that never used to need a college degree to enter, right? It's that much more important to know what are our tools available for planning, not just one, but all of them, to see which one is going to fit right for us. And that example I have there is this couple funding life insurance in a 10-year period of time. They were going to put $5,000 away per child per year, to over 10 years, $50,000 per child, and do a cash value building life insurance policy where gains are sheltered from any taxation, no dividends or capital gains tax owed each year on the interest that they're accumulating within those policies. And they were going to end with probably close to $160,000 available for their kids to use for college expenses. And because it's not in those more restrictive options like a 529 plan, it can be used for expenses that might not seem needed in association with college, right? Above and beyond just room and board and tuition, right? In addition to that, let's say we have a more entrepreneurial spirit child, right? That doesn't want to go to college, right? Now that 529 really didn't do them as much good, right? So the life insurance policy is going to have much more flexibility on how those funds are able to be used and applied to whatever that child might do to pursue in their later years.
Well, let me ask you a quick question here, Glenn. Does that money have to be designated as that child as the beneficiary? And then does it have to go to that child?
No, not at all. Well, I think if our child, God forbid, passes away while owning the life insurance, they're not receiving the proceeds, right? The owner of the policy. So in this circumstance, as I used as the example, the parents owned the life insurance policies. The parents were in full control of them. Beneficiary designations, all of that, the parents had control of. The kids are just the insured. The person that is insured that if something happens to one of those children, the death benefit would topically be paid, in this circumstance, to the parents. Right. Yes. And God forbid, I know that's not what the parents were hoping for their kids. They're not buying life insurance because they're expecting these 0 and 1 year old children to pass away on them. Right. They want to see those kids live to a ripe, long age. But, the mechanism of life insurance allowed them to set that money into that policy, grow tax-free, and then be able to use later, and even structured in a way that they could at one point give those policies to their children. I have personal experience with this again. A colleague of mine whose parents bought life insurance from when he was just a young child, and in his teen years, he got not a terminal, but a chronic health condition, Before he even entered the workforce, he now has a health condition that would make it almost impossible for him to even qualify to buy life insurance. The fact that his parents helped set something up when he was still young and healthy meant now that he was uninsurable in his 20s, he still had insurance because his parents planned and protected him like that.
Absolutely. Well, let's talk about some of the other benefits where applies to saving for college. You've talked about the facts that the number one, it's tax-free withdrawal. I see someone saying here that no FAFSA impact, which
Correct.
is, these are the kinds of things that people need to think about when they start to save their money and they start trying to figure out how to pay for college. So maybe you can explain that.
Yeah. So it's easy answer is that it's not counted. Right. The funds that are inside that cash value life insurance policy aren't counted as those liquid assets that we would have to offset the additional need for any financial help that we might qualify for. Right. Mm-hmm. So now, even though we are setting this money aside for them, it's not counted against them because we did it that way.
These funds can be used for any purpose. Now, maybe your intention is to say for college purposes, but they can be used for any purpose and you aren't going to be penalized, correct?
Correct. There is no strings attached to it. It is just a cash value life insurance policy. Yeah. And just like any other cash value life insurance policy, the cash within that policy, you own it. It's yours to do with as you speak. And there is no restrictions on what those funds are used for, which as I mentioned earlier, maybe that's going to be seed money to an entrepreneur child who wants to start their own business rather than go to college, right? Maybe those funds will be applied to help them get their startup business or purchasing their first vehicle, all those other things that are outside the scope of college.
Well, and Glenn, we always know that life changes, and maybe by the time you are ready to retire, your kids have gone in a different direction. You can use that money, right?
100%. Again, it's so being the owner of the policy allows you to have that control. Right? You haven't given that policy to the child. You, the parent or grandparent, own the policy. And if that child does change their mind and they don't want to go to college and they're not going to start a business, well, I hope they're still going to do good for themselves. But in that circumstance, the parent or grandparent could say, you know what? I'm going to use these funds now. Since they're not going to use them, I didn't designate it in a way that I cannot take it back for myself and use it for what I want to.
Absolutely.
And Kim, if I may add, with obviously 4 in college or somewhere in college, medical, whatever it is, that no FAFSA impact is a big one because every year when my wife would fill it out, because I didn't make my wife, but I kind of made my wife fill it out, she would get frustrated and it has no impact on that. And we know income potentially does have an impact. The tax-free withdrawals, that goes without saying. How can you not like tax-free? Right. There's no contribution limits. Unlike 529s, there's no IRS contribution caps. So that is a great benefit. And most people don't think of life insurance for college plan as a college planning tool. But when structured right, and Glenn just recently did that, as he mentioned, it can be one of the most tax efficient, most flexible, and it can be used for building legacy, protecting your family, and a whole bunch of other reasons. And I'll use this as a segue to say, maybe you're listening and you have life insurance and you haven't had it looked at in years. Now may be a good time to make sure that it's going to perform the way you want it to. We do a lot of life insurance reviews, and I'll let Glenn briefly touch on it. And we see it eating itself, some policies eating themselves up. It's not performing the way it should be. And maybe now you still have an opportunity to make changes if it makes sense. And then it also coordinates a lot with long-term care coverage and various things that are out there. So, yes, we're talking about college planning, but maybe you're thinking, well, I have life insurance and I really haven't paid any attention to it for years. That'd be maybe another reason to come in and visit it with Glenn and do a life insurance review, which has no cost to it. And you have nothing more than to gain to make sure that you have confidence in what you've been paying all these years is going to do what you expect it to do.
Let me ask you guys this. What about, you get a 529, you put it in and it fluctuates with the market. Is there any growth potential when you put money in these insurance policies, or is it just sitting stagnant?
No, absolutely growth potential there. A lot of companies are either going to structure this through a policy that's got a fixed rate of return in it. And due to the high interest environment we're out, those fixed rate of returns are actually a lot better than they have in the past 10 to 20 years. On top of that, they're going to, we call shadow the market. They're not going to invest that money into the stock market, but they are going to give you a performance. They usually refer to this as an indexing strategy, where they're going to monitor a stock index. And when that stock index is up, you're receiving a portion of the gains that are happening within the index. But you're also sheltered from the losses. When that index is negative, you're just not getting interest that year. And in a negative market year, zero interest and zero loss is a good thing. Right. I'm sure a lot of us are experiencing right now a desire to be in a market position that we weren't losing in, right? With everything that's going on in our markets today.
Oh, well, let me ask both of you, gentlemen, what are the downside? What's the downside here? Because I haven't heard anything that sounded particularly negative.
Time horizon, it could be the only downside. This isn't something that you do in 2 or 3 years. Right. Mm-hmm. Ideally, this is a 10-year or longer investment strategy. Right. So it could be the only, if there is a downside, that's the only one I could think of.
Okay. Well, so universal life insurance, very interesting. And if you'd like to ask more questions, or you heard what Larry had to say, and boy, he couldn't be more right. If you've got a life insurance policy that no one's looked at for a long time, this may be the time to take a look at it, make sure it's been reviewed, and make sure that you actually are invested in something that you think you're invested in. 612-504-8400. That is how you get hold of the experts at Haven Financial Group. Give them a call. Let them know that you heard us here on the radio. Glenn, you're going to stay with us, right? We're going to talk a little bit more. Super. We're going to talk about wealth stability and family finances on the other side of the break. This is the Haven Financial Group Radio Show.